this is Sam. I'll be kicking off the 12:30 follow-up session. So let's go ahead and dive in. So the topic of today is going to be position sizing for small accounts. And hopefully we're going to just keep this really short and sweet because I think this should be pretty straightforward. So let's say that a small account is anything under, and I hate putting numbers on things because, you know, someone out there's got $1 million account and someone out there's got a $500 account. And so all these things are, you know, it's honestly irrelevant. Here's what I'll tell you. If you have $1 million account or if you have a $500 account, if you show me that your trades make 30 to 50%, I don't care whether you have $1 million or 500. I want to follow your stuff. Somebody who makes a big win on $1 million account is worth less to me than someone who can consistently hit 20, 30, 40, 50% with a small account. So regardless of where you are, I would imagine most of us, you know, there's a very few John Carters in the world. So I would imagine most of us are on the other side of the spectrum. It's irrelevant. You'll get there. Just be confident that you can hit base hits and be confident that that is your measure of success. When John makes 30,000, 40,000 on a trade in 15 minutes, that's John's size. He didn't get there overnight. And so again, just trust, at least from a professional trading point of view, I would more want to follow somebody who can hit base hits consistently than somebody who hits home runs. And so don't feel bad if you're not a home run hitter. You can get into the Hall of Fame hitting singles, doubles, and triples all day. So let's say that a small account is anything under the day trading limit. That just gives us a good measurement. So underneath, what is it, the number, 25K? So with that idea in mind, Tony Gwynn, exactly. Tony Gwynn made it to the Hall of Fame, right? I would imagine he did. I actually have a story about Tony Gwynn. I'll save it as to spare the editor, but I'll come back to it. With that idea in mind, we want to be ultra cautious, ultra aware, whatever you want to say, ultra aware of risk. So what does that mean? Well, here's a rule of thumb. And I'll share with you what I actually do. You can choose which one works for you. Position size for each trade somewhere between 1 to 5% of the account. Okay. So let's use a $10,000 account just to make the math really easy. So if we were following our rules, $10,000 account, 1% would be, what is that, $100? 5% would be 500. So for a $1,000 account, excuse me, 10,000. The common position size would be $100 to $500 for the entire trade. So that looks a couple of different ways. It can be a $100 to $500 call or put. It can be a $100 to $500 call put spread. It could be be a $100 to $500 butterfly. Doesn't matter. Risk looks a lot of different ways, but again, the main thing to understand is just try to keep it between 1 to 5% of your account. That's why John's trades look so big, because he's working with a much bigger account. but I think he sticks pretty close to these rules. So this is kind of just the rule of thumb. Example and rules of thumb. So then I'll tell you what I do. Oh, and let me add something else here. It's a great idea, and this probably needs some stars. All right, and hopefully that answers your question, Crispino. The number of positions is irrelevant. It all depends on your position sizing and your percentage of your account. The thing is, I try not to have more than 75% of my account in multiple trades at any given time. So the main thing is just try to leave yourself 25% in cash at all times. Just because you never know what you need to do. You might need to cover yourself. You might need to hedge. You might need to add. So just having that 25% in dry powder is helpful. So that's the rule of thumb there. Now let me show you what I actually do. So what I actually do. Gotta love that, right? Like, let me show you what the book says, and let me show you what I actually do. So I'm just going to use the same example: $10,000 account. For myself, you know, I go a little bit bigger, right? I don't mind going a little bit bigger. Now, keep in mind, you want to. We'll come back and talk about this, but let's see. For myself, what I actually do is 3 to about. Well, I'm just going to shoot straight with you. 10% of the account. Much more risky. If you're new, it's okay to be new and take it slow and prove to yourself that you can do it. If you're new, follow this. You won't get hurt. Much more risky, but this is honestly what I do. So 3 to 5%, 3 to 10% of a 10K account. For an example, would be $300 to $1,000 per trade. And here's how I figure it out. Here's the difference. Rule of thumb and what I do. This is worth the space here. So I try to think of trading like blackjack, right? So you can bet the same amount. Hopefully that sentence makes sense. So I treat trading like I should say treat. I treat trading like blackjack. You can bet the same amount every single hand. So, for example, you sit down at a $10 blackjack table. Yeah, you can just bet $10 every single hand. But there's strategies that you can use, right? You can start, and I'm kind of working under the assumption you can count cards. If you can count cards, then obviously if the count is in your favor and there's more large cards in the deck, you want to bet more. So what I do is I rank my setups, right? So what I do is rank my setups. Basically, if the setup is A plus, I will And here's the thing, doing it this way just kind of keeps you out of trouble because one, it keeps you from shotgunning the trades, right? Instead of just walking into the room and spraying the market with trades, you're really looking for that A plus setup. So for an example of an A plus setup, might have been something like net yesterday, right? But that's the general idea. So, the question for yourself that you must ask, because I can't answer it for you, what constitutes, well, that's not the way you spell that. What constitutes an A plus setup for you? I'll give you my example. Moving averages aligned, multiple squeezes from daily to intraday, momentum clearly defined, doesn't matter what direction, price near support, indexes confirming stock bias. So that would be an example of mine, right? When you have the moving averages aligned with multiple squeezes from the daily to the intraday, when you have the momentum clearly defined, when you have a price near support, and when you have the indexes confirming the bias. What does that mean? Basically just means that if you think the stock's going up, the indexes can tell you the same thing. That would be an example of an A+ setup, and that would be something that I would go ahead and do a 10% of my account. The good thing about this is even if you're going to be doing the top one here, which is the more rule of thumb way, I would still suggest doing that. Instead, you're just playing with different percentages, but your game is still the same. If it's a so-so setup, don't do more than 1%. In reality, if it's a so-so setup, just leave it alone. Because why would you ever, you can kind of see the mentality here in the psychology. Once you start qualifying your setups, instead of just saying, oh, here's a setup 5%, here's another setup 5%. That's a schmuck way of doing it. So instead, qualify your setups. Say, okay, that looks like an A setup. I'll commit 3%. That's an A+. I'll do 5. That's maybe a B+. I would do 1, but instead, I'm just not going to take it, right? And you can see how just by understanding this is this is almost fully psychology. Like there's almost no real market things that we look into. This is 100% psychology. Only you can click the button. So it's 100% psychology. And once you start doing that, you're just going to not take those 1% trades. You're just going to say, hey, I'll just stick around for the A+, the A's, and I'll just leave the B's and the C's to somebody else. So that's kind of what I got for you. I will fix that word. Aside from that, let me see if there's any questions. If you're new, again, stick to the top one. If you are a little bit more experienced, stick to the bottom one. Here's just a couple of extra points that I'll add. But again, the more points I add, the more flexibility it gives you, the more problems you'll have. So keep in mind, the more if you're new, try to be inflexible at first with your risk. But just a couple of points. If you can commit to a stop, let's just say 50% of the debit paid, then you can size bigger. So for example, using the first rule of thumb, 3 to 5%. Most we could bet on that example, if we're following the rule of thumb, is 5%, right? So let's say we buy a $500 call, but we commit, and this is the psychology, we commit that if the call drops to 250 or 50%, doesn't matter, of the debit paid, we are out. Okay. So in that example, we can either do one $10 call or 2 $5 calls. You see why? Because if we commit, and this is the hard part. So again, if you're new, don't go here yet. You do have to build up to it. It may sound easy, but the psychology is it's 51% of the game. Because if we commit to the 50% up rule, then in either situation, the most we can lose is still 5%. Just a little thing there for you to have some flexibility with. Normally, that's what I do. I try not to get into situations where I'm risking the debit paid completely, although I do understand that, right? So you should still go into the trade risking the debit paid in your mind, but at the same time, if you can prove to yourself that you can have the psychological consistency to pull a trade if it drops 50%, then you can size bigger, because at the end of the day, you're still betting only 5% of the account. So I think that might cover most of it. I definitely don't want to just talk your ear off. So if you guys want to take a picture of the notes, let's see if I can get that. All right, there's a picture of the notes. For a credit spread, you're not paying money. How do you determine the size? Well, for the credit spread, that's a good point. So I'll just put it in the notes. It's not worth a note, but I'll put it in the notes. For credit spreads, since you are taking in a credit, you're risking the credit received. Well, you're actually still risking the other side. So let me just give you a practical example. Let's just do something simple. Let's say that we did a $5 wide put credit spread and got a credit of let's say 225, just to make it a little bit more difficult. So we're doing a $5 wide put credit spread this time because we didn't take in a debit. We took in a credit. So how does that change things, right? With the debit, it's easy. If we had paid 225 for this put vertical, if we had paid 225, we know our max risk, 225. If you're using the 50% rule, your risk is about 112.5. But just to keep it simple, your risk is just what you paid. In this instance, because we didn't pay anything initially, we actually took in an initial credit because we sold it as a put credit spread. How much is our risk here? Well, our risk is just the difference between the width of the spread and the credit. So the risk here $5 width minus 225 credit equals 275 of total risk. Okay. And then you would just do that with anything with a credit. So if you were to do a condor and it's 20 wide and you take in a $5 credit, then you have $15 worth of risk. Anything like that. So just a good rule of thumb there. Personal win percentage on A+ setups. I don't keep track of it that way, Trista. I don't. It would probably be a good idea to do so. The one thing I can tell you is the more A+ setups you take, the more you'll be likely to only take those. You'll see that a lot in the room sessions. Folks will ask me about different stocks, this, that, or the other, and a lot of them are like B's, C's setups. I wouldn't even trade them. And then you'll have your A+s, which trade well. I would say that the hit rate on an A+ setup is probably, for myself, probably 2 out of 3 to 3 out of 4. with an A+ setup that meets all of these parameters. And because here's the thing, with an A+ setup, you will have a high win percentage because look at everything that you're waiting for to align, right? So because the parameters that got you in are a lot tighter, the win rate's a lot better, right? So this is probably a good bit of homework for you guys is if you tonight or whenever you get a chance, write down what is an A+ setup for yourself. It will have some of this. You could use this as well. I mean, I think that's fine, but write it down for yourself and ask yourself, what is an A+ setup for me? And then really force yourself to stick to that, and just ignore anything that doesn't meet those parameters. Can I show you an example of an A+ trade? Yeah, I suppose. I'm trying to think of one off the top of my head. The only one that comes to mind is net. Let me think if I have another one. Maybe a fresh one. The market's kind of ugly here, so I won't have a perfect one. Yeah, I'll use net because it's easy enough. Now the question is, it's a very personal question, right? What is an A+ setup for you? But I'll show you my parameters. So net here from yesterday, I would say was an A+ setup. And here's what I'm looking for. Starting with the daily. If the daily doesn't have some promise, up or down, again, I don't care, up or down, then I'm just gonna leave it alone. But on the daily here, you see how your moving averages are aligned? The 8, 21, 50, 100. So that's the first thing I look for, is alignment of the moving averages. They do have to have an angle. So you see how they're angled up and they're all sequentially aligned? That's the first thing I'm looking for. The second thing I'm looking for is the overall market. So as of yesterday, I did the open with you guys. We bought the open. It ended up going okay. We were bullish the market. So we have this daily trend and we have the indexes. That's 2 checks so far. Do we have a squeeze on the daily? That's the third thing. Yes, we do. Did we have squeezes on the sub time frames? Not just the daily, but the 195 and the 130. We had high compression on the 130, low compression on the 195. So that gets a check. That gets a check. Is our momentum structures positively positioned to justify the long? This is completely positive. This is completely positive. This is completely positive. This is positive still, although pushing it. This is positive, and this is positive. Also, just for kicks, this is positive, right? So we have that as well. And then the last thing is, am I getting a good price? Am I getting a good entry? Well, yesterday we got in right in here, right? We got in on this pull. It was below 22. I don't remember the exact price we got in from a stock perspective. I remember we paid like 170 for the calls, or 270 was maybe. Are you getting a good price? Notice the structure the entry kind of came in last. I had to justify all of this stuff first, and you can do it really quickly once you get quick at it. And then, am I getting a good entry? And yesterday we did. So this would qualify as an A+ setup for myself. Moving averages, momentum structures, the stock market was confirming yesterday, squeezes on multiple sub time frames, and a good entry price. One more thing I'll add. Is it above your key Fibonacci? In this case, it was. So it seems like with the overnight gaps, let's go back to the, let's watch the market here. Seems like with the overnight gaps is likely the stock, then factor that into the possible not being able to stop out because it can blow through the stop. Yeah, Miller time. I mean, if you're going into, yeah, hey, that's a valid point. I mean, if with the overnight gaps, yes, if you're in a position, can it gap against you and go over 50%? Yeah, absolutely can. Be mindful of that, and if that's the case, then maybe position size even smaller. Here's another thing, and maybe this is actually worth putting in the notes for the folks that stuck around for this part. In volatile environments like we have now, Position size smaller because you don't need to go big. Yeah, so that's a really important one. Try to look at everything as a blackjack hand. Not just the stock itself, not the chart itself, but the entire market, and ask yourself, in this volatile market, is this a safe place for me to put on a multi-month swing trade? Probably not, right? Probably not. So in that environment, what do you do to justify or to conform the risk? Well, you position size smaller, and you probably either go shorter dated. If you're playing it kind of an intraday pattern, you go even shorter, or you go slightly longer, but you keep your position size small. And that's how you adjust for that. Market's trying. Yes, TW Dan, did you get a chance to take a picture of that? Do you trade SPX credit spreads on expiration day? Sure. Yeah. I mean, we had one today. It was on the SPY, and I got rid of it maybe slightly too early. But yeah, of course. That's actually a good way to do it if you're trying to limit risk. So, for example, we did the SPY put credit spread yesterday, and I did it for today. It would have been 100% better off if I did it for yesterday, right? We would have been able to close it at a max profit. It would have expired worthless. So there's a lot of advantages to it. You can see that by holding it overnight, I took the overnight risk. I didn't think there was much overnight risk, but we opened up a little bit weak today. It would have been 100% better off if I just had done the exact same trade with yesterday's expiration. So don't be afraid of that. There's no issue there. And actually, in this market, it actually is quite justifiable to do it that way. All right, guys. Last call for questions. Any questions? All right, guys. Thanks for the time. Hope this was helpful.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me over.